Welcome to Talk Tickers. Today, we're digging into a classic Wall Street mystery. You know the kind. A company reports what looks like a fantastic quarter, beats all the estimates, and then you watch the stock just get absolutely crushed. Well, that's exactly what happened with FB Financial, and we're going to figure out why.
So FB Financial put up some really strong numbers that blew past what analysts were expecting, but the market totally hated it. This is one of those classic situations where the headline numbers look great, but the smart money, well, they're digging into the story behind the numbers, and that's exactly what we're going to do.
So first, on the bottom line, they beat adjusted earnings per share estimates by 4 cents. They came in at a solid $1.16.
And the top line looked good too. Revenue came in hot, over $2.5 million ahead of what everyone was looking for. A big part of that was their net interest margin, that key profit number for any bank, basically the spread between what it earns on loans and what it pays out on deposits.
But here's the kicker. Despite all that good news, the stock just plummeted over the next 2 days. So the billion-dollar question is, what did the market see that the headlines completely missed?
All right, let's get into it. First up, let's look at the official results. Because, on the surface, this quarter looked really good.
I mean, look at this. All the key metrics are pointing up. A clear beat on earnings and revenue. And that year-over-year loan growth, a whopping 29%, mostly thanks to their big acquisition of Southern States. And that net interest margin we just talked about, almost 4%. Looking in the rearview mirror, things looked fantastic.
And this chart just drives that earnings beat home. You can see it right there. The company was firing on all cylinders when it came to profitability. They posted an adjusted return on assets of 1.51% and a return on tangible common equity of almost 16%. I mean, by any measure, those are just very healthy numbers.
Okay, so if the numbers were so good, the problem had to be somewhere else. It had to be in the story they told. So let's shift gears and listen to what management actually said on their earnings call, because this is where the plot thickens.
The entire call was really all about the future, about 2026. Management was pretty confident, but they also flat out admitted that organic growth in 2025 was a weak spot. They said it was partly because they were distracted by that huge acquisition. So the message was clear. 2026 is all about execution.
And the CEO, Chris Holmes, he really set the tone. He signaled this big back-to-basics approach. Now, this is a huge pivot from 2025, which was all about growing through acquisitions. He's basically telling the market, hey, we're done buying growth for now. It's time to start building it from the ground up. And right now, in this kind of economic environment, that term, organic growth, it's everything. With interest rates where they are, big M&A deals are way more expensive and risky, so the market is laser-focused on finding banks that can grow their loans and deposits internally. It's really the purest sign of a healthy business.
And this guidance, this is where the doubt really started to creep in for investors. After a year where they themselves admitted organic growth was weak, people started asking, okay, is this new target really achievable? And maybe more importantly, is it going to be high-quality growth? Or are you just going to be chasing numbers while you're still trying to digest this massive company you just bought?
And this is where you see that huge disconnect. Management's trying to paint this rosy picture of future growth, but the market's reaction was swift and it was brutal. The promise of a better 2026 just wasn't enough to justify the stock's high price today.
And the reaction wasn't just some pre-market panic. It was a slow burn. After a little dip on the day of the announcement, the real selling pressure hit the next day. That's after all the analysts and big investors had time to really digest that guidance and start asking hard questions about that future growth.
And then Wall Street made its opinion official. A downgrade from a major firm like Piper Sandler basically cemented this new, more skeptical story. The downgrade note said it all. After a huge run-up, the stock was just priced for perfection. And that earnings call, well, it showed that things were a little less than perfect. This slide really sums up the whole story. It's like management and the market were speaking two different languages. Management was talking about the great Q4 they just had. The market heard that organic growth was weak. Management talked about a confident outlook. The market heard questions about growth quality. This is the divergence that tanked the stock.
So, let's put it all together. Where do we go from here with FBK? We've seen the numbers, we've heard the news story, and we've definitely seen the market's verdict. What's the call?
Okay, our thesis is this. The story for this stock has completely changed. It's not about getting bigger anymore. It's about proving you can get better, organically. And until the company gives the market cold, hard proof that they can do that, well, the stock is probably going to be stuck in neutral. It's officially a show-me story. So for the next call, we're kicking things off with a market perform rating. What does that mean? Basically, we see the risks and rewards as pretty balanced right now. The company's got solid fundamentals, but there's a huge question mark hanging over this all-important transition to organic growth.
And for our final thought, here's a potential trade idea. Given how focused the market is on growth quality, a classic play you might see from a hedge fund is what's called a pairs trade. The idea is you'd go long or buy the stock of a regional bank that has a proven track record of strong organic growth, and at the same time, you'd go short FBK. The bet is simple, that the proven winner keeps winning while FBK might stumble, causing that performance gap between the two stocks to get even wider.
So that wraps up our breakdown of FB Financial's wild quarter. The company delivered the numbers, but now the market is demanding a completely new story. It's up to management to prove they can write it. This is not financial advice.